Welcome back to my channel, Balance Sheets Matter. In this video, we're going to be going over CoStar Group and do a stock analysis. But before getting into the analysis, make sure to subscribe to my channel, Balance Sheets Matter. I do individual stock analysis videos, so if you like looking at individual stocks, want to get good ideas on potential stocks to buy, value traps to avoid, make sure to subscribe to the channel. And if you do want me to look at a video or a stock, I can do a video in the future. Just leave it in the comments below. And also make sure to subscribe to the channel and like the video, of course. So getting in the CoStar Group, you can basically see they have fallen quite a lot from the chart on the right here. They were trading actually from, into 2020 to up till recently in 2025 in this, $70 to $90 range. And now they've fallen quite significantly, almost 70% down to $32.50. And a lot of this is basically because of the threat of AI coming with Claude and ChatGPT, and pretty much all the software stocks have been falling. So I think before we dive really into the numbers here, you kind of do have to understand what the actual business of CoStar Group is and kind of make a little judgment on your own. Is this really actually going to be something that's disrupted by AI? Because a lot of the threat, I think, comes from AI is people think that, they're aggregating real estate data on their different platforms. You can see their kind of suite of different basically websites they have, homes.com, apartments.com, LoopNet. They're basically targeting residential, commercial real estate. And a lot of this basically is for information and analytics, which they basically sell to real estate professionals. And the thing is why this is unlikely to be disrupted is they say basically 70-80% of the data they're basically aggregating themselves and selling in this package basically is proprietary data. So this isn't something that can really easily be disrupted and AI can actually take over. And then on top of that, a lot of their platforms as well, such as Loop.net, Homes.com, Apartments.com, what's happening is the different brokers and real estate listing agents and people trying to rent or sell their properties, they're paying for the listing on these platforms themselves. And that's where they're also generating a lot of the money. So this isn't really something that's going to be able to disrupt them, because if people are going looking for a home, looking for an apartment that they're basically CoStar Group now is heavily advertising, for example, homes.com or apartments.com recently, you come across these websites and you're basically looking for your apartments there or your home there, potentially buy or rent. And it's basically the person renting it, they're paying, CoStar Group for the real estate of showing you that. So that's also something that's really not going to be disrupted by AI as well. So let's now get with that. You can make your own decision basically if you really think it's disruptable or not. We're going to dive into basically the financials now. So looking at some of these top level metrics, the first thing to notice is the PE is sitting very, very high, which I'll explain basically why that is shortly, sitting at 542. But they do have a much more modest forward PE of 23.84. So this is basically expecting their earnings going 1 year into the future based on the company's own guidance, and the analysts is going to be, actually quite a lot higher than what it currently is. And if you look at the little Guru Focus value band, it is showing that it is significantly undervalued. And even though it's way, way under this band here, it's actually not saying a potential value trap, which is kind of interesting. So we dive into the 30-year financials here. You can first get an idea of basically where the revenue trends are going. And you can basically see the revenue trend line in the blue here has been the long-term average. And if projected out, basically it would be at a 19%. But the actual revenue projections by the owns company's guidance and analysts here, it's in the green. And it's a little bit more moderate trend, which I think is a little bit closer to 15% or maybe a touch lower. And if we can see on the growth rates per share, the revenue basically growth rate per share over the last 10 years has been marginally lower at 13%. And the EPS basically is a little bit all over the place right now. This is without NRI, without non-recurring income at 9.8%. So for a variety of reasons, I'll show you basically why that's going to be not as relevant as we dive down further in the analysis. And also one of these things that I like to look in a lot of the other videos, return on invested capital. But when you have a really high PE and you aren't really showing any profits, well, this is actually a pretty irrelevant number to basically look at. Although you can just get an idea of what their weighted average cost of capital is, because if they did basically need to, take on debt or dilute shares, this is generally the kind of, cost they would be absorbing. And, that does factor in at their current share price. So when we do see the revenue, you can see it actually has been growing, quite a bit at a very fast rate. And they have been maintaining very high gross margins, basically close to 80%. So based on this growth rate here, I think the company still does actually have quite a lot of runway ahead of them. They're kind of, if you think of a company like, for example, like Booking.com, they're kind of becoming the whole conglomerate in basically the real estate market of, for listings, for commercial and residential, and that's where they're really trying to position themselves. But what's really happened recently is, well, you can see their operating income has actually dropped, and they actually have a slight operating loss now. And this is because of their selling and general admin has gone up quite a bit. But why has that actually been? Well, if you dive basically into their consolidated financial statements, you can kind of see where it's all coming from. And in the last 3 months, basically ending March 31st, you can see out of what was here of their total basically, right here, of like 547 in selling and general admin, 421 million of that was basically selling and marketing. And this is because they've been going on a big, basically, selling like and marketing basically binge, trying to advertise homes.com and apartments.com primarily, along with some of their other businesses, because, well, they historically were a little bit more in the commercial real estate market. They're really trying to branch out into the residential as well. And I do think this is basically a good justifiable reason, like allocation of capital, since as they do grow their revenue, probably their selling and basically their advertising expense is not going to scale up at the same rate. And that's probably basically why the EPS is expected to rise in the future, and or at least the next year, and will continue to basically rise in the future. So you kind of do have to look a little bit more in context when you see very large rises like this and understand where they're coming from. And you can also see there's a little bit of research and development, which is primarily upgrading their web platforms themselves. And they do have basically some positive like net interest income at $82 million. It was higher before because, as I'll show, they were sitting on a little bit of higher of a cash pile, but they have used that for a lot of acquisitions recently, which has basically left them with less money. So we'll be kind of evaluating their balance sheet as we go further down. And with all of that, they're left at a very, very tiny profit of 6 cents per share right now, which is pretty irrelevant. And the interesting thing is, you can see on the shares outstanding here, they're sitting at 414 million. But if we go over the longer term, they actually have been basically increasing their share count, because they have been issuing it based on stock-based compensation and just some general dilution to basically do acquisitions and raise cash. But what's interesting is they've actually started buying back a little bit of stock recently. As you can see in basically the previous quarter, they're up to 432 million shares, and they've actually started buying some back and now are down to 414 million. So this is kind of the first time the company's actually really started buying back shares, which could be hinting towards maybe a little bit of undervaluation, considering this whole time up until now, they basically haven't had any inclination to basically buy back any shares. So let's judge the strength of their balance sheet here. You can see basically right now the current assets are sitting at 1.7 billion, which 1.2 billion of that is in cash and cash equivalents, which is basically where they're making that interest income from. But you can see from basically 2023 here, they were sitting at 5.4 billion, a lot of cash. That's where all the interest was coming from, but they basically spent all that to grow the business. And we compare that to their total current liabilities. Their total current liabilities are sitting quite a bit lower at just under $800 million. So this is a very good current ratio, and basically does tell you that they probably are sitting on about $1 billion of extra cash that they could deploy in various ways, of either doing share buybacks or using that money for acquisitions. And then when we look at their total assets, they're sitting at basically $10 billion. We kind of do have to factor in that there's $5 billion of that is goodwill. So you kind of have to subtract that out of their total equity to kind of get more idea what the tangible, book value is. And what's really nice, though, is the total long-term liabilities are only at 1.4 billion, with total liabilities only sitting at 2.2 billion, because they are sitting at relatively low debt of only 994 million. So when you do see a company that is low debt, it basically does open the opportunity, if they did want to issue basically bonds in the future to raise capital. That is something they do have opportunity to do. And usually when you're a little bit smaller, you can't really issue bonds at a good rate. But as they do get larger and solidify themselves basically more as a monopoly in their market, they will likely be able to issue bonds at favorable rates that they basically can use that money to expand in the future. So that is a potential avenue they can basically raise capital grow versus issuing shares. And then there's some capital lease obligations, and not much more other than that. And that's basically leaving them with a little bit under $8 billion of total equity, but we kind of do have to subtract out the $5 billion of basically the goodwill. And if we compare that to the total market cap, the market cap is sitting at just over $13 billion. So they are sitting on with their tangibles and their kind of intangible tangibles of like, their IP and their domain names basically of a few $1 billion, which actually is about almost $3 billion, which is basically actually a fairly significant portion of their market cap. So you kind of do have to, in this case, apply that in, that they have maybe about $3 billion on their balance sheet in excess for a $13 billion market cap. So that is basically signifying they do have a fairly strong balance sheet, and we do have to apply a little bit of value them in that way. Next, basically getting in the cash flow statement, you can really see where the money in the business is going and what the business is. Usually one of the things I do look at is cash flow from depreciation compared to the purchase of plant, property, and equipment. As any growing company, you should expect the purchase of plant, property, and equipment to be higher, which it is, but that isn't where the majority basically of their money goes. You can see a lot of their money, basically a lot more basically goes to the purchase of businesses because they do acquisitions. They buy different, domain names like homes.com several years ago. And even a few years ago, I just need to look it up quickly, but they basically want to expand more internationally. And they bought Domain Holdings Australia. And this was basically for almost this $2.3 billion we're basically seeing here because they wanted to expand into the international market. So, long term, this hopefully will be basically a good acquisition. And if it isn't, well, you'll see them write it down and that'll pop up in their income statement under basically the other operating income expenses. So typically when you do basically write down your goodwill, this is where it's going to show up on this line here. So we get back into the cash flow statement. The key thing is how they are expanding their business. They're not actually investing in themselves so much. They're really doing acquisitions to fuel a lot of their growth and expansion. So that's something, that you do need to understand about the business. And you can see here, they actually never were repurchasing stock for all these years. And like I said recently, since the stock has dropped a lot, they've actually started purchasing quite a bit of shares with $986 million in shares in basically the last year, with the majority of that in the last 2 quarters. So I think that's quite interesting that because the stock has basically fallen a lot, that this is the first time they decided to buy back shares. This probably is signifying that the management does think the stock is relatively attractive for them to invest their money basically like that, just by buying back shares. And that they do have a little basically a free cash flow at the end of the day, but with a strong balance sheet and the ability if they really needed to issue debt, I do think they are sitting in quite a strong basically overall financial position to basically continue their overall expansions. So now we just get into a little bit of the relative valuation here. We're going to pop up the revenue with estimate, and this is just what we were seeing on the first screen within the little chart before. And you can see basically they are expected to continue to grow their revenue up to basically the estimates at the end of 2030 to $6.2 billion. But what's really impressive is the expected EPS growth. And this is without the non-recurring income here. And based on their own guidance, it's pretty much what it's saying here. 1.36 is what management basically has said they're going to get for their guidance, which does have a relatively low forward PE of only 23.52, I think it was. And based on the analyst estimates, they're actually expecting to ramp this up quite aggressively to 426 potentially by 2030. Whether this will actually happen really depends on if they want to show profitability or not, because you got to remember a lot of their expenses come down to marketing. So even though these are the expected basically by analyst projections, EPS growth expectations in the future, this is going to be dependent if they actually want to show those profits or if they're going to basically reinvesting the money back into advertising. So that is something you have to factor, but if they probably weren't choosing to dump a whole bunch of money into advertising, these do seem like numbers that basically could be potentially achieved. Because I did do a little bit of a quick math on it, and it would get to more, I think, net profit margins of about 20% getting to those numbers there. So that does seem like quite reasonable based on the profit margins they basically had in the past. And, it does seem pretty achievable overall. And, I don't want to look at the PE. I actually want to look at the price to sales. I think price to sales for growth companies like this is a good way to judge it. And you kind of can see right now, they're sitting at a 4.1 price to sales ratio, which is pretty comparable. Basically, it's their previous bottom in 2002 and a little bit higher than the bottom in 2009. But they are a little bit bigger now, so that is kind of something you could say that, hey, that might actually garner them a little bit lower price to sales ratio in the future. So that's kind of something you kind of have to decide if that's actually a good way to value it or not. So what I have done here is basically, this isn't really a discounted cash flow calculator. This is more discounted earnings calculator, basically taking the expected earnings estimate and using basically kind of, a compound, what the compound growth rate is going to be to get there based on kind of two various PEs. So I kind of put a lower PE at 25 and a higher one at 40. Since if we look at something at Booking.com, which they have $27 billion of revenue themselves, Booking.com, they still trade, quite often a 40p ratio. And I think that is something that basically CoStar could realistically achieve in the, several years in the future. And if they were to basically get this EPS at the end of 2030, that would actually work out to buying at the price now of a 43% per year annual compounded growth rate. And even if you look at a lower basically PE of 25, then you're still looking at about a 30%. And if you want to mess with this number, think it's going to be a little bit lower, you can knock it down, and you can still basically see that the potential growth rates would be pretty good for this. So I do think it is somewhat of a little bit of attractive investment. And jumping into the chart here, you can kind of see this is more of a technical analysis, but my technicals analysis does usually revolve somewhat around the fundamentals, because this is basically the longer term trend channel that's been developing. And what I have here is basically the average compound annual growth rate it's been going up at, which has been 15% per year. And this actually does seem like a realistic goal that basically CoStar could achieve. And if they were to basically reach the expected kind of rates I was talking about, they would be trading somewhere about up here, which would be kind of that reversion basically back to the mid channel. So in the short term right now, they are kind of a bit of a falling knife, as you can see basically even today, even though other parts of the market up, well, software is down again, and they're still dropping. So it's really hard to basically say with stocks like this, when you're catching a falling knife, when to buy into them. You can kind of look at how previous bottoms have developed and see that they typically do take a little while. I don't think this is going to be one and done. And if we go back to, for example, 2008, you can see how long that bottom took. Even these little bottoms here, it's, it does take months and months and months. And even the 2001, they, bounced around, quite a while actually from, March 2001 to November 2002. They hit the same bottom over and over and over. Actually, they even hit it in 1999. So that is something until the sentiment basically changes that basically could shift for CoStar, is I would probably want to wait for them to get a little bit of a bottoming pattern, like a lot of these software companies basically out there. There still is the uncertainty that are they going to basically actually be disrupted? And while a lot of other companies, like for example ServiceNow, they keep showing good earnings, but the stock keeps dropping, that kind of, and a lot of those are actually cheaper than CoStar Group, even with the forward PE of 23.52, I think compared to their peers, they still do look relatively expensive. So this kind of could mean that there could be a little bit more potential downside in the stock. So, personally, I'm kind of waiting to kind of see a little bit more clear of a bottoming signal. If you're kind of really a bit of a, doomer just on technicals, this easily could go down to about $20. You can see there's a little bit of a price profile there, and this would break the channel, which probably would basically then be signifying also that they would be having a slower growth rate than this 15% going on in the future. But I think the main thing basically with CoStar right now is they kind of in all scenarios, I think, are likely going to do quite well in the future. It just depends how well that's basically going to be. And right now, while they're kind of in this falling knife mode, I'm personally just kind of waiting to kind of see a bottom start developing over a few months. And, that's basically probably when I'm going to jump in. But overall, I think over the longer term, they're probably going to basically be a pretty good long-term stock to have in the portfolio. So anyways, that's my analysis on CoStar Group. You can leave your thoughts in the comments. Make sure to subscribe to the channel and like the video.